Welcome to the daily update, where I'll go over the action in the market for Friday, May 24th, and then we'll see how things look for Tuesday, May 28th. The markets will be closed in the U.S. on Monday in observance of Memorial Day. Before I get started, please know that I am going to be launching my program at the beginning of June, and at that time, on Monday, June 3rd, I will be locking down the daily videos. Now, they'll still be freely available, but after the market closes. I set a timer up. The minute the market closes, those videos become public, because about half the people that watch the videos watch them after the market is already closed for the day. If you want to have early access to those, you can either become a member in my whole program, and that'll be $97 a month. If you don't want to be a member, but you still want to have early access to the videos, that will be $19 a month. Now, the weekly videos that I do, those are going to be available as posted. The foundation of all my analysis and all the strategies and everything that I teach and that I do come from the daily videos. All the weekly videos are more supplementary. They just give us a bigger picture look at what's really happening with the daily charts. If you want to talk to me about this, you're welcome to send me an email. Here's an email address. You can put a comment on one of the videos. We can set up a time, talk about this, if that's something that you would like to discuss. I also want to wish everybody a very happy Memorial Day. A lot of people have served America since its beginning and have sacrificed their lives. And I'm very grateful to not only the people that sacrificed, but their families as well. And this is a day that we set aside to remember them, in addition to Veterans Day and even the 4th of July. Maybe we should have another day. That's how I feel about it. But this is also the unofficial start of summer. It's a 3-day weekend. There'll be a lot of barbecues, and I hope everybody has just a wonderful, safe weekend. All right. Let's go back and talk about what happened right at the open. We did have a gap higher open, and prices came above the daily pivot at 52.89, but we, for some reason, hit resistance right at that 53.05 level. That wasn't a pivot point, but we tried like 3 times to get above that level and just couldn't. As the day went on, we chopped between 53.05 and 5300. By the time we closed, we were slightly above 5300. So that's kind of a positive takeaway. These are just round numbers. Now, they can become technically significant based on our charts, but they're usually not important from that standpoint, at least when they first appear. But it's a psychological thing that the financial media digs into, that investors dig into, and they just look at this round number and say, okay, we were able to get above 5,300 by the time we closed. So that did show some improvement, especially after Thursday, when a lot of damage was done technically. And a lot of that damage is still there, but it is looking to be improving slightly. We were up 0.7%, not quite as much as we were down in Thursday's session, but we're still below average with volume. Now, some of this can be explained because it's the week or the day before a holiday weekend, but we've been seeing below average volume really for the last couple of weeks, almost since the last Fed meeting. Volume has really dropped down to below average. We are positive in the short, intermediate, and long term when we take the big picture look, but there are some areas of weakness that we need to be aware of and respect those and see if are they going to start going away if we go up, or if we go sideways to down, are these weak areas going to develop and look even stronger? So, and I'll go through the charts and show you that. Because of the 3-day weekend, we always want to keep a mind open to geopolitical events. Let's just hope nothing like that happens over the weekend. Some comments. The Dow continues to underperform. Even though it's coming off of setting a recent all-time high, it's still underperforming the other indexes, but the NASDAQ ended up setting a new all-time high on Friday. We have a pretty short list with our extreme positive readings right now in the short-term overbought or extreme positive category. We have the stochastics chart. Now, that's 3 charts together, and that's why it takes longer for this to adjust. And then we have the slope oscillator, which is extreme positive, but now it's dropping more below its moving average. Intermediate term, we still have the TTM squeeze, the Sean trend meter, and then the 10-period moving average study for the S&P based on the highs minus the lows. Long term, we're coming down. We're getting really close with that 150 moving average, but we're not quite below being extreme. The 200 is holding up a little bit better. It moves a bit slower. The scenario has not changed. Now, in the upcoming week, in Friday's session, we're going to get the PCE report, which includes the core PCE. That's the other big inflation report, the one that the Fed tends to focus on, and that might make a change in the scenario. But until then, there's really nothing that has happened where the Fed is going to leave rates higher for longer. And because inflation has not been coming down the way it had been before, they're trying to get to that 2% level. And the market is anticipating possibly September, when, if the Fed even ends up cutting rates, that might be when that happens. And I'll be going through the probability charts over the weekend. And then the bounce up that we saw after we had been declining in April, that's really a large part being attributed to the Fed decreasing their quantitative tapering. And that's just adding more liquidity into the market. And a lot of that money goes in to buy stocks and really helps things to go higher. The dollar was down and interest rates were also down. This gave some support to stocks. We closed at 4.46% with the 10-year yield, where after Thursday, we were at 4.48%. We're still inverted with the yield curves. Sentiment actually ticked down on an up day. We had been at 54 after Thursday. After Friday, we're still neutral at 53. Our trend is still positive. The green line's on top, but it's coming down, and the ADX is dropping a little bit further below its moving average. So that suggests a weakening trend, but we're still above 20. Not very far, but we're above 20. With the up day, our bias is positive, and then the last number of days taken together, that's how I measure our momentum. We're still mixed to positive. Thursday did a lot of damage when we were really going down, and it kind of caught a lot of the market off guard. And so we just need to be aware of those things until they either get stronger and we turn more negative, or we go up and these weaker areas start to show more improvement. The economic reports, we had durable goods. It came in a lot higher than expected, being up 0.7%. They thought it was going to be down 0.8%. Last time it was up 0.8%. When you take out transportation, also stronger than expected, coming in up 0.4%. They expected 0.2%. Last time it was unchanged. Consumer sentiment, the final reading came in at 69.1, stronger than the 67.6 they had expected, and also up from the last reading of 67.4. So here's some charts. This is year over year look at durable goods, where we're going back up a little bit, but we're still not very far above zero on a year over year basis. We take out aircraft on a year over year basis, looking a little bit stronger and not too far above zero currently. Month over month, we are declining, but we were still positive from the last reading. And here's consumer sentiment, where all the lines are jumbled up together. So there's not a real big difference between the blue line, which is the reading that we get, and then the yellow line, which are the expectations looking out into the future. And then the purple line is how people are feeling right now. They're kind of feeling the same right now and into the future. And it's a little bit more pessimistic than it had been. And here's also showing the blue line, which is the decrease in consumer sentiment. I also put the 2-year yield on here just to give us a reference point with interest rates. Here's some blog charts. These are the top 10 mega caps, and what is their percent of the S&P? That's the blue area over here. And then you have the Professor and Marianne part of the market, the rest, all the way over on this side. Now, they still are bigger on a percentage basis, but just to know that, there's a small group of stocks that have really been having the most impact on the market. And we just see that confirmed by this pie chart here. Then looking at inflows into cyclicals and equities, we look at this from the US standpoint. That's the dark blue line here, even though it's been coming down lately. And this is kind of what's been giving us some concern lately. We're seeing things like staples and utilities, and we're keeping an eye on healthcare and to a degree, energy. Those are more defensive, not so much energy. That kind of comes and goes being defensive, but staples and utilities, yeah, they're defensive. And so that's why we're seeing this coming down a little bit. Cyclical stocks flow with the economy. When we're having a strong economy, these stocks do better. When we're having a weaker economy, these stocks tend to underperform. We're also comparing that with Europe. and we're not seeing a real huge difference between the two right now. Then looking at how inflation assets have really underperformed. This is the light blue line. These are deflation assets, and they measure this going back to the 1960s. And it kind of stands to reason. I mean, inflation is an enemy of the stock market for most of the things that are in the stock market. And so if inflation seems to be more under control, that means that the deflation areas, the stocks that benefit from inflation going down, would actually outperform. And we have the US, we have China, we have Japan, we have the European countries. If you were to rank them on what is the biggest economy, the US government could be the third biggest economy in the world. And it's just growing. Now it's falling back a little bit here since the whole COVID plunge and the lockdowns and everything, but it's still very, very high. And whether you agree or disagree with that, we just kind of have to take it for what it is. And then I'm not sure how applicable this is right now because it's the days until a new high. Well, we've just recently set all-time highs over here, so we don't have a very big number of days that we've been waiting for one. And then what is the likelihood of a recession? Actually, they reverse this and they say what is that it's unlikely. And we're seeing this continue to go up. More people are thinking we're going to end up going through a soft landing. Now, at some point, we're going to go into we're going to go into a recession. We just don't know when that's going to be. Is it going to be this economic cycle or at some point in the future? That's what Keynesian economics does, and that's what the U.S. economy is based on, and pretty much the world, at least Western countries are. And so at some point, we will do that. We're trying to figure out if in the near future, if something like that is going to happen. And we could see a shift. We could start to see some of these things coming out that suggest that a recession may happen. We're not seeing that yet. We can take the recession pro charts and the recession con charts and make an argument for either side. And that's been part of the debate that's been going back and forth. Here's an interesting chart from Twitter put out by Sentiment Trader. Back in the 1930s, if you took $1 and you only invested around the holidays, that would grow to, they don't give an actual amount here. It's probably about $10 or so. The market tends to have positive seasonality around holidays. And since we're dealing with that right now, this chart somewhat applies to what's happening. Then we look at kind of a different variation of other charts I'll be showing you here in just a moment. This is the S&P, which is in black. And then we have blue, which I also use blue. This is growth. That's the top chart. And it's still outperforming when we take a longer term look. We're seeing more shorter term weakness, and that's what's causing us some problems. We did see a little bit of an improvement on Friday, but we need to see more follow through. And then this purple line here where I use a red line, that shows longer term that it's been underperforming. And same company, two different conclusions. On the top, JP Morgan traders see NVIDIA economy fueling S&P 500 gains. Right at the same time, actually, I guess it was a day later that it was published, JP Morgan warns S&P 500 could tumble 20% by end of the year. Yeah, okay. That's why we reach our own conclusions. If you try to pay attention to the financial media, let alone these companies that actually manage money for people, it depends on who answers the phone when you ask them a question. And yet you're basing things on the fact that these people have a conviction behind the opinions that they have. Well, even within the same company, they can differ. All right, here's our intraday chart where we did gap higher and there was no attempt to fill the gap. We saw a little bit of chopping right after the open, but then we went above the daily pivot and we got up to this 53.05 level, and that was the high for the session. We came back down a little bit, but then closed above 5,300. So that part is being taken more psychologically as positive. Here's our intraday chart, also showing the improvement that we saw in Friday's session after Thursday's weakness. We are still looking a little better here with our growth to value intraday chart. The blue line is still above the red line. We're also seeing an improvement here with our ratio between growth and value for the SPY. And then our end of day charts, we were up with growth where value was down. We were up more with mid caps and also up more with small caps. So Friday was a pretty good day for growth. We now want to see follow through from this instead of just these one really good days that then trail off into not really doing much after that. We want to see day after day of this developing if a lot of this weakness that we're seeing is going to go away. Here's our end of day chart for small caps for you. We saw a bit of a bounce here. We also saw a bit of a bounce with the mid caps, and we saw a bit of an improvement here with the S&P growth to value end of day chart. We're seeing some improvement here with growth to value with these ETFs. We're coming a little bit further up out of the rainbow, but we're not seeing that much of an improvement with discretionary. We turned up, but we've been chopping sideways lately where we want to see this really going up now, and it's just not. Large cap growth also was able to recapture some of the losses that we saw on Thursday. The Wilshire also was up on the session. This is a broad market measure. Our trend, we're still starting to fall below the moving average, but we're still above 20. But the green line is coming down. And you would think on an up day, even though I was talking with somebody, and this would be called an inside day, where the high and the low are inside the day's previous bar. But this was kind of a strange day. We saw a bigger move than what we've been seeing in quite a while. So we'll see if that ends up meaning anything or not. But we are on top of the green line, but it is declining, and the ADX is falling below its moving average. We're seeing pretty much that same thing in the short term as well. We want to see this get back above the moving average and see the moving average in the green line turn back up to turn more positive. Volume just continues to drop off. Now, Friday's session can kind of be explained away. It was the day before a 3-day weekend. But we've been seeing below average volume just trailing off here as we were going up in May. And that's a negative divergence that we've been seeing pretty much for the whole month now. Sentiment, we ticked up just a little bit with the Ulcer Index. This is probably still figuring in parts of what happened on Thursday. The latest reading from Investors Intelligence that we had a few days ago came in at 3.4. We're above the 3 level, but we're not really at an extreme point now. We did decline with the VIX when we look at the line chart and the bar chart. So that's falling back down to levels where we tend to see better annualized returns. And we came back down with the VIX of the VIX, where this had been going up. Then we had the down day and then the up day on Friday. So the volatility of the VIX is starting to drop back down. The MACD is showing that we're still headed down with the momentum of the VIX, but it was trying to turn back up. If this can stay at these lower levels, we probably would still see the MACD below its moving average. We're keeping an eye on this. We're up into the red area now with the skew index. This means that the market is expecting some kind of a move. We're not sure if that's an upward move or a downward move, or if it's just a continuation. But this is up into this area, and you can look at these arrows to see what happened other times, whether it was mark the top, bottom, or a continuation. We did go up with the equity put call ratio. There were probably some folks that were hedging ahead of a 3-day weekend, a very common thing to do in case something really weird happens. And we're going back up with our 5-period chart. This tends to be negative for the market. We're seeing a little bit of a tick up just into the underside of this band when we look at the volatility risk premium. We ticked down with this fear gauge. We also declined slightly with this other fear gauge. So we saw more across the board confirmation that fear had subsided a bit on Friday. Here's the consumer sentiment, the chart. I thought I showed this a while ago, but apparently not. This is just showing that folks are getting a little more pessimistic about things as the blue line's been coming down. And I also plot the 2-year treasury yield here as well. Looking at our advanced decline line studies, we saw this was big red bars in Thursday's session. So it's a little more positive when we see green bars for Friday's session as we're going back up slightly based on price and volume. We're still looking a little more negative with our 5-period moving average of the highs minus the lows, and we're also declining with the 10-period. And we didn't really see an expansion of new lows. What we're seeing is more of a contraction of the new highs. We had dropped below 0 with our 19-day advanced decline ratio. That was able to get back above 0. So that's turning more positive shorter term. We turned back up slightly with accumulation distribution. So that's also looking a little more positive. We ticked up a little bit with the Chaikin money flow, but we still see the moving average continue to decline. But this is positive for right now. Chaikin oscillator still is declining, but above zero. We look at our cumulative advanced decline line for the NYSE, where that was positive. And we also ticked back up with our regular NYSE advanced decline line. We also ticked back up with this other NYSE advanced decline line. And when we look at common stock, the advanced decline line for the NYSE, we ticked back up based on price as well as volume. We're also showing a bit of an improvement with our cumulative measure for S&P 500 based on price and volume. And we turn back up with all of our different advanced decline lines. We're still above the moving averages. So this is holding together for right now. Here's our chart where really not much is really coming out in this chart. We have some pivot points above current price. We have other pivot points which may act as support below current price. And we're still above the 50-period moving average. Over here on the bottom, you see where volume really dropped down below average even more than it has been. We're coming back up slightly, but not quite extreme with the short-term stochastic. We're coming down in the intermediate term after being extreme. We're rolling over, but still extreme with the long-term stochastic. And we're coming back up into both of these lines right now with our 20-period double and triple exponential moving average study. We ticked back up with the 20, 50, and 200 with this moving average study. The force index was able to go up and is still positive. We want to keep an eye on these 20-period moving averages. If we see more weakness, and as these are coming up, will this end up providing support if we see a decline? We're right at the top end of the +2 standard deviations channel. When I consider this to be extreme is when we get up into the +3. So we're not extreme here. We're still coming down with the balance of power. However, we're above zero. So this is positive, but declining still. We've still switched over to the lighter blue bars with the go, no-go system. Dark blue is positive. Light blue just means, yeah, we're still kind of positive, but maybe leaning a little bit more negative. And we're still near the blue line here with our highest high value, and we're above the midpoint. The TTM squeeze is now turning darker blue, where it had been lighter blue as we were going up, but we're still getting an extreme positive reading. And we're still above the 50-period double and triple exponential moving average. So maybe these are providing some kind of support. We want to keep an eye on the 50-period moving averages just in case we see more weakness. And we're coming back down with the ease of movement, but we're still above zero. So we didn't see an improvement on this chart. The Erin is flattening out as well, but it's also positive when we look at the oscillator below. We're still negative here, where we bounced up with the S&P McClellan oscillator, but we're still below zero. So we're still going down with the summation index based on price and volume. This is more negative intermediate term. First, we need to see this go back above zero. If it can stay above zero, then we would see these lines start to turn back up. We're not seeing that yet. We're also seeing more negative action with the NYSE McClellan oscillator. We bounced back up, but we're still below zero. So we're starting to decline with the NYSE summation index based on price and volume. We're negative still with the Swenlin trading oscillator. Even with the up day on Friday, this is still going lower and is pretty much just flat out negative. We're rolling over a bit with the PMO, which is one of our more intermediate term oscillators. We're rolling over based on price. We haven't quite hit the moving average yet based on volume. So this is some of the weakness that we're still keeping an eye on. We bounced back up with the PMOs that are rising, but we had really declined. We're still declining with the buy signals, and now we're declining with the PMOs that are above zero. We continue to be neutral with the Elder's Impulse system for the S&P. We continue to be negative with the parabolic SAR. We have a second dot on top. We're going to have to get above this high that we set on Thursday to have this really turn back more positive. A slope oscillator, still extreme, but starting to fall below its moving average. We're rolling over with the MACD, but still positive. So we're looking a little more vulnerable in the short term with the oscillators that measure our momentum. We're rolling over, but not close to the moving averages in the intermediate term. The long-term oscillators continue to go up. We're still above all the moving averages here in our moving average tree. And the longer we can stay above that, the more these moving averages are going to show improvement. We came down a bit with the bullish percent index, but we're not really screaming to the downside right now. We came down with the NYSE bullish percent index, and we ticked down slightly with the NASDAQ 100 bullish percent index on an up day. Kind of a little bit of a concern there. Look at the money flow. Yeah, I did have the right date on there. The money flow did decline, but it's still above 50. Ultimate oscillator getting right down, just barely above 50. If this drops below 50, that will turn negative. We're looking at the vortex. The green line is still coming down, but it's still on top. So we're positive, but we're concerned that this green line is coming down. We ticked up a little bit with our RSI 14 and our RSI 9, but we're not extreme. Both of these continue to be above 50. So longer term, they're still looking more positive. We ticked up with unbalanced volume, and we're still above the moving average. We dropped below 50 with our 20-period moving average of those stocks inside the S&P, but we're still below 50. And we ticked back up with this other study here, wondering, we saw a really nice thrust up. And we saw that before, where we saw this really go up, and then it actually looked more negative before it thrust up again. That's what we're waiting to see if will happen going forward from here. The 50-period moving average study, we did tick up, but we're still under 50 there. We ticked up with the 100, and we ticked up with the 200, and we're above 50 with both of those. So the longer term is holding up better. The copy curve is rolling over, but is still positive for right now. The Sean trend meter did tick up, and we're in that second area of being extreme positive. The Pring bottom fisher also rolling over, but we're still working off of the buy signal that was generated back in April. And just so you know, I'm going to stop showing the mass index because that signal was triggered over a week ago, and I believe that's become irrelevant now. Looking at the trend, when we look at the Heiken Ashi chart, we're still looking a little more negative here with the dark colored candles. We're positive with the Kegi chart, but now we're pointing down. So it's positive with a negative slant. The Renko chart is still positive, and the 3-line break is still positive there. Long term, we're coming really close to this red line with the 150. We're still well above this red line when we look at the 200. So they're still extreme positive, but showing a little bit of weakness. We did have the first part of a Hindenburg omen, and I haven't even looked at any perma-bear stuff yet, but they're probably this is going to make their Memorial Day weekend. We saw a spike up here, okay? Now, what we need to watch for is within 20 trading days, which is roughly a month from now, we need to see another spike within that time period, and that could be quite negative for the market. But we can't make it look negative until we actually see confirmation, because we saw one last February that led to nothing, and then the market just really went higher after that. If we get a second one, we'll want to really pay attention, because you can see when we had confirming signals, what the market did after that. This was at the end of 2021, and then we went into 2022. So if you're positive on the market, you do not want to see a confirmation of this signal. Our different indexes, we're back to looking positive on all time frames across all the indexes according to the Keller market model. We're still negative with bonds in the intermediate and long term, and now we're switching back down to a downtrend with the US dollar index. No changes here on the decision point scorecard. Positive in the short and intermediate term, mixed in the long term. And we started out by seeing an awful lot of red with our alerts, but then as the day went on, we saw some interesting things. Now, the S&P did set a new all-time high. Is that right? We didn't set an all-time high in Friday's session, but that's what it's saying here. It might be an intraday high, but we didn't surpass Thursday's high. All right, I'm not sure what to make of this. We're seeing some discrepancies here. Looking at the sectors, all the sectors except healthcare were up, with communication and utilities leading the way higher. Discretionary had a pretty good day. Now, this is something else I wanted to bring up. I go over this usually in the weekend videos, where this is an alternative to traditional Dow theory, which uses the Dow and compares it with the transports. Well, then I look at another chart where instead of using the Dow, we use the S&P, and instead of using the transports, we use the NASDAQ. And then I have another variation of that, where instead of looking at the S&P, we look at the equal weight S&P, and then we compare it with an equal weight QQQ, NASDAQ 100. Notice here that we have not set all-time highs here. So this is a little bit of a concern. The indexes have set recent all-time highs, but when you treat all the stocks the same, that's not being confirmed by what we're seeing when we look at the equal weight indexes. Just another little warning sign to be aware of. We look at the ratio between the two, and we saw that the mega caps really did a lot better in Friday's session. So this is starting to break out. That just shows that the big stocks outperformed the rest of the market. The Dow is still underneath this pivot point, and it was up 0.01%. It was virtually unchanged. And we're looking at a further deterioration here when we look at the transports to S&P 500 ratio. This is something that the market may have to deal with at some point. This has been going on for a while now, well back into 2023. We want to see this ratio going up. And at some point, this ratio is going to be going down. Everyone's going to start talking about it. Everybody's going to notice it. And then that's about the time it actually gets dealt with. That's why I want to show this to you now before I mean, there are people that are talking about this, but it's not the talk of the market at this point. We look at the diamonds. We continue to be neutral with the Elder's Impulse system. We are looking pretty good here with the NASDAQ, and we did close at a new all-time high, but we have not set a new intraday all-time high. NASDAQ 100, the same thing. New closing high, but not an intraday high, because we still closed below yesterday's open. And then looking at the Qs, we remain neutral with the Elder's Impulse system. The momentum is still looking positive for the NASDAQ 100. We're still above both of these moving averages. This is looking a little more positive the longer we stay above these moving averages for the Qs. Small caps, yeah, they bounced up off of their 50-day moving average, but we're still inside of this range that we've been in all of 2024. We still remain neutral with the Elder's Impulse system for the small caps, even though they were up over 1%. And looking at the Russell 2000 small caps, we're coming right back up to 50 with the RSI. We're still above the 50-day moving average. The momentum, though, is starting to turn more negative. Mid caps also still above their 50-day moving average for right now, but they still remain negative when you compare it to the Elder's Impulse system. Apple ended up being up, still above its 200-day moving average, still in a longer-term downtrend. The longer it can stay up here, the more chance we see of seeing a golden cross here. Tesla, also in a downtrend, was up over 3%, but it has a lot of damage to repair. NVIDIA just keeps going up here. It's up another 2.5%, setting new all-time highs, and pretty much everybody's darling stock right now. Microsoft was up 0.75% and still looking pretty solid. Meta was also up, but still underneath its 50-day moving average. Amazon was actually down a little bit and still dealing with its 50-day moving average. Google coming off of recent all-time highs, but was up on Friday. Netflix was also up in Friday's session, but not back to the previous all-time high set back in 2021. The FANG index saw a nice little bounce and is closing at a new all-time high. The financial sector trying to bounce up off its 50-day moving average. We're still watching this ratio. We want to see this continue to go down. That means that staples are underperforming tech. If this continues to fall, that would be more positive for the tech sector. The dollar ended up declining, but it's still in an uptrend when measured by using moving averages. And looking at our correlation, we're dropping off a little bit when we look at the S&P and compare it with a world ETF. We're still showing a little bit of strength when we look at the longer-term correlation. Staples were up 0.25%, but still have been one of the stronger areas and causing us some concern. Utilities were also up, causing us a bit of concern because these are defensive areas. Healthcare ended up being down, so we're not seeing, even though it's in an uptrend, we're not seeing an awful lot of strength here. And energy was up a little bit, but it's still in a longer-term uptrend. However, it's below its 50-day moving average. Total U.S. stocks did show a nice little bounce back up here, but not back to its all-time high yet. Keeping an eye on interest rates, we were down with the 10-year yield. We were up with the 10-year based on price. That helped give support to stocks. Looking at the bonds to stock ratio, it's now ticking back down. We want to see this continue to decline if we're going to be more positive with stocks. The tech sector is looking better when comparing it to 3 to 7 year bonds. That ratio continues to go up. And we're also seeing the Qs when we compare them to bonds also continuing to go up. So that part is holding up better. Then looking at our growth to value ratios, we are seeing some improvement with Qs to the S&P, but we're seeing weakness with discretionary to the S&P. We're seeing large cap growth looking a little stronger when we compare it to large cap value. So with the large caps, we're looking better. We've come back above a declining moving average with the mid caps, and we're also above the moving average with the small caps. So yeah, okay, we had a good day on Friday, but we need to see these all go up, and we need to see the moving average turn up. We're still looking okay here with our 10-day average of the S&P 500 highs minus the lows. We've been camped up in extreme positive territory. We did cross back above zero with our advanced decline line based on price and volume. Well, we never got below zero based on volume. We did drop below on Thursday. The S&P to utilities ratio ticked back up, but we want to see this really going back up if we're going to be more positive on the S&P. And then looking at the staples to S&P, we want to continue to see this going down if we're going to be more positive with the S&P. So what's our outlook for Tuesday? Please know that the markets will be closed on Monday. And then the technicals, they're positive. We do see developing weakness. Is it starting to get better? It did a little bit in Friday's session. Now we need to see, is it going to carry over into Tuesday's session? And we do have a period of positive seasonality that I'll show you here in just a moment. We're going to get the FHFA Housing Price Index on Tuesday and the S&P Case-Shiller Home Price Index. So we're going to get some real estate housing information earlier in the week, and we're going to get consumer confidence as well. We want to keep an eye on all the crazy things going on in the world, especially over the weekend, just hoping that nothing really weird happens. Here's the upcoming economic calendar. Of course, we're closed on Monday. I've already gone through what's happening on Tuesday. Not really much of anything. This is what we see every week on Wednesday. We're going to get the second GDP reading on Thursday. Now, this could be a non-event if the reading comes in pretty much the same as the first one. But if we see a big change in it, that could really impact the market. So we don't know if that's going to be a big deal or not. The big report of the week is going to be on Friday. Personal income and spending and core PCE. And then please note that we'll be closed. I've told you what, 4 times now? Yeah. All right. So looking at May 28th, we're positive seasonality wise. So that we've got that going for us now. And we're also looking positive when we look at the green dashed line during an election year. And you can see this green line continues to go up into the end of May. April, my gosh, that ended quite a while ago now. But Tuesday tends to be not all that great in and of itself when we look at what happened in 2023. We're also coming into the end of May now, where typically we see some positive seasonality going forward from here. We're wondering if that's what's going to happen this time. We also see some good seasonality, according to Carson, going into the end of May. And then we look at May here, and I don't know why they did this. We still have 1 week to go in the month, but it says stocks up 5% in May is a very good thing. Well, yeah, but we haven't finished the month yet. And it's up 100% of the time, going back to 1950, and we get a 19.9% return. So, but we don't know. I mean, if this week ends up being positive, yeah, then this will come into play. But I think they posted this about a week early here. And then according to Tom Bowley, we're now out of the negative part of May, and we're coming into the positive part of May. So our warning signs, we did make a new all-time high recently with the S&P, with staples and utilities being quite strong. We're just keeping an eye on that. We're also watching energy as well as healthcare. The growth to value ratios and discretionary to staples, they're not really showing the leadership role that we would like to see right now. But in Friday's session, they did improve. The Swenlin trading oscillator is negative. The parabolic SAR is negative. The slope oscillator is crossed below its moving average. The equity put call ratio is going up, which is negative. And we're seeing the summation indexes for the S&P and NYSE, they are declining now. Positive side, all our oscillators are positive except for the slope oscillator and the McClellan oscillators. We're still looking good with the bullish percent index. We're looking good with the ultimate oscillator, the Chaikin money flow, the Chaikin oscillator, the money flow index, the vortex, the Copic curve, and the momentum for the NASDAQ 100, as well as the bullish percent index. in the financial sector. So we still have a lot of positive things to hang on right now. So our conclusion, we are positive. We still have to treat this as weakness is developing until we're proven otherwise. But it did get better on Friday, and we are coming into a period of positive seasonality. That's what we're focused on in the short term, which would go pretty much for the upcoming week. When we look out a little bit further, we're still showing some weakness. The parabolic SAR, the summation indexes, they're still negative. We're still looking positive when we look at our long-term basis here. Thank you. Again, I want to wish you a very happy Memorial Day weekend. I will be posting the videos. They may be a little bit different because of the holiday. I've got a little more flexibility with how I prepare and post those. But look for those if they're of interest to you. So have a really good day, and I will talk to you in the next video.